Hello, everyone. I'm Denise Mauzerall, a professor joint between Civil Environmental Engineering and the Center for Policy Research on Energy and Environment in the School of Public and International Affairs. I'm extremely pleased today to have the honor of introducing Professor Patrick Bolton, the Barbara and David Zalaznick Professor of Business at Columbia Business School and a visiting professor of finance at Imperial College London. He's the co-director of the Center for Contracts and Economic Organization at the Columbia Law School and research associate of the National Bureau of Economic Research, a research fellow of the Center for Economic Policy Research, and a fellow of the European Corporate Governance Institute. Prior to joining Columbia, he taught at UC Berkeley, at Harvard, at l'École Polytechnique, the London School of Economics, L'Université Libre de Brussels, and at Princeton University as the John Scully 66 Professor of Finance and Economics from 1998 to 2005. His recent research examines the broader risks posed by climate change to the financial system overall and how financial industry regulators like central banks and financial authorities and asset managers like rating agencies and institutional investors should incorporate climate risks into their economic modeling, risk assessments, and financial stress testing. Climate change mitigation activities in this framework are a key part of self-insuring against these risks. Today, his keynote talk will be on managing climate change-related financial risk, and we greatly look forward to your talk. Please take it away.
Thank you very much, Denise, for this kind introduction. Thank you for the organizers for inviting me, to Atif and Elke, who I'm very happy to see at least on screen. So I have prepared a slide deck, maybe too many slides. So in the interest of time, let me share my screen right away and get started. I imagine everyone can see this and hear me. Okay, so yeah, the title of my talk is Managing Climate Change Related Financial Risk. What I will do is give you a sort of general introduction of how I would like to frame the question, and then I will turn to more specific things about climate finance as a risk management problem. I will discuss briefly some research I've done on net zero portfolio alignment, and also on the role of central banks in dealing with climate change risk, and then I will conclude. So, you know, even though this is an obvious point, it is worth repeating. Market economies are not designed to protect the climate and the planet. And earlier in the panel, we had a call to teach more sustainability issues. And that's absolutely right, because economics has often failed to recognize this basic problem. And here, in the words of Nick Stern, in his Ely lecture in 2008, he said greenhouse gas emissions are externalities and represent the biggest market failure the world has seen. Unfortunately, companies have been told to just focus on making money. That's the prescription of Milton Friedman, and he basically argued they shouldn't worry about their impact on the environment and society. Protecting the environment and society should be left to government. Of course, what he didn't say, but is obvious to all of you, is that companies are free to lobby against regulations, in particular lobby for the abolition of the Environmental Protection Agency. You know, this is still something that is being recommended by major Republican politicians today. So markets are not good at protecting the climate and the planet. How did governments do? Well, governments have been slow to act. Now, here you have a picture that I like, that I took from a presentation by Scott Barrett in 2015. That was his view, his vision on how climate negotiations were proceeding at the time of Paris. And as you can see here, he basically thought that the world was going around in circles and not really progressing. And when it comes to looking at the record, we see that governments have failed to curb greenhouse gas emissions. We see a tiny little blip down here at the bottom here. That's the COVID lockdown effect. Unfortunately, this has been now reversed as we emerged out of COVID. So the government failure to act on climate change largely explains the rise of ESG. Basically, more and more investors have understood by now that they can no longer just focus on making money, leaving environmental and social issues to politics. And the ESG movement started, maybe 20 years ago or so. At the time, it was like a niche sector of the financial industry, but today it represents 130 trillion of assets under management, which is about 40% of global financial assets that are associated with the Glasgow Financial Alliance for Net Zero that was launched by Mark Carney at the COP26. So what can ESG accomplish? What can ESG-minded investors accomplish? And here I want to start by saying that often we find there are confusing aspirations. For example, some people are saying that financial markets could do what governments have failed to do if they were to wholeheartedly embrace climate finance. But I would like to make, my first point is that investors and financial markets can't substitute for government. They can complement government action, not get in the way of public policies, and bring forward in time the effects of future expected climate mitigation policies. But if asset managers were to attempt to replace government, they would quickly face pushback and backlash. So I don't think that's the way we want to think about ESG. Now, another misconception that we often hear is that ESG allows investors to do well by doing good. So the claim here is that, and that's backed by some academic research, as you can see here on the slide, the claim is that companies that embrace ESG and that reduce their carbon emissions are the better companies that can also deliver better operating performance. And there's some empirical backing for that claim. The problem, though, is that you have to also argue that their better operating performance isn't fully reflected in the stock price. That in effect, financial markets exhibit a form of short-termism. Now, that may well have been true in the early years of ESG, but today, in a mature market with 40% of financial assets pursuing some form of ESG strategy, it's no longer possible for ESG strategies to generate alpha. In other words, to allow investors to do well by doing good. Another major debate around ESG is whether investors should divest or engage. So you have the militants, for example, like 350.org, who are arguing that divestment, for example, from fossil fuel companies, will help combat climate change. That's the language that they're using. And I'm not denying that that's true, but we all know that institutional investors, by and large, do not want to divest. And we've had, two prominent statements. Here I've taken one from CalPERS and CalSTRS, who have said, that's taken from their websites, that institutional investors themselves firmly believe that engagement is the first call of action. And until recently, the Harvard University Endowment has stated its position that it has a strong presumption against divesting investment assets. The endowment is a resource, not an instrument to impel social or political change. The point about engagement, and this isn't often properly acknowledged, is that despite the large size of assets under management that claim to have an ESG tilt, and the vast coalition that I've just mentioned that assembled by Mark Carney, there's little evidence that shareholder engagement has had a significant impact in curbing corporate carbon emissions. So what are we to make of all that? Well, what I want to argue is that the proper way to think about what the industry should be doing, the financial industry, when it comes to climate finance, is that it should really think systematically about climate finance related risks as a risk management problem. And the first person to really make this statement very clearly is Bob Litterman. Already in 2010, he made the statement that I have quoted here on the slide. Let me quickly read it for you. Not pricing risk appropriately leads to disasters. Start by thinking about what would be the appropriate price for carbon emissions today. What should the price reflect? The price should reflect the risk created by carbon emissions clearly. Yet the situation we have today with respect to carbon emissions is that not only are emissions currently not reflecting a premium, they are not even reflecting the expected discounted damages. How serious is it when a systematic risk is not priced appropriately? Recall that what caused the financial crisis was also a systematic risk that wasn't being priced. Not pricing systematic risk leads to too much risk being taken, and such a situation will eventually lead to a high probability of a global catastrophe. This is very clearly stated. This was written in 2010, and we're now 12 years later, and it's still as relevant as it was then. So if we're thinking of climate finance as a risk management problem, how does that translate into investor actions? And what I want to argue is that there are really three implications for investors. The first one is that investors seeking to manage the risks related to climate change, they will want to hedge climate change risk by reducing their exposure to this risk. That's the first point. The second point is that investors will demand compensation for holding this risk. And the third point is that investors will, of course, engage with companies to induce them to reduce this risk. Now, the point here is that reducing exposure to carbon transition risk is a form of divestment. And that can be justified purely based on prudent risk management. So we're not talking about politics here. We're not talking about changing the world. We're just talking about risk management. So let me now turn, with that in mind, to what that might mean concretely. And here I want to briefly describe some research I've done on net zero portfolio alignment. The idea of net zero portfolio alignment is that the carbon footprint of portfolios should be aligned with national net zero commitments. Now, what we have today is two large coalitions that have been formed. One is an asset owner coalition, UN-convened Asset Owners Net Zero Alliance, and the other one is the Net Zero Asset Managers Initiative. And your pension money is probably managed by one of the asset managers in that Net Zero initiative. Now, what's important to realize is that even though these coalitions have been formed, there's no concrete portfolio decarbonization methodology proposed by any of these coalitions. And for example, the Net Zero Asset Managers Initiative states that it commits to support the goal of net zero greenhouse gas emissions by 2050, commits to setting interim targets for 2030 consistent with a fair share of the 50% global reduction in CO2. But what does that mean? And we were heard on the panel earlier that more and more people will now hold institutions, companies, and institutional investors and so on to account for what they're saying about what they want to do about the climate. And here, I think the case will be made that this is more like empty rhetoric if you haven't got a concrete proposal of what you're going to do. So with that in mind, my co-authors, Marcin Kakpersit, Frederick Samama, and I wrote a paper, Net Zero Carbon Portfolio Alignment, where we are trying to map out what concretely that might mean to have a net zero aligned portfolio. And we take the perspective of a well-diversified investor who takes the world as given and who aims to reduce the portfolio carbon footprint to net zero by 2050. Okay, so this is not someone who has power to change the world. It's someone who wants to be aligned, but cannot on his or her own change things out there. Now, of course, if all companies in the portfolio are net zero aligned, then the portfolio is also net zero aligned. The problem only arises if the companies in the portfolio are not on a net zero pathway. And then the question arises, how do you adjust the portfolio so that the portfolio at least remains net zero aligned? And the optimization problem we consider is how do you make adjustments to the portfolio, keep it net zero aligned, while minimizing tracking error. So what that means concretely is that you want to look at a portfolio that is net zero aligned in terms of carbon footprint, but in a way that minimizes the risk to the investor, the holder of portfolio. Of course, investor could buy green companies and be net zero aligned immediately, but that would expose the investor to a lot of undiversified risk. So what does it mean for a portfolio to be net zero aligned? And here the idea we are introducing in our paper is the idea of a carbon budget and how to apply that to a portfolio. So we know that to limit global warming to 1.5 degrees centigrade with an 83% probability, we only have a maximum total amount of 300 gigatons of CO2 left that can be emitted into the atmosphere as of 2020. Now, the IEA estimated that global annual energy-related emissions were 31.5 gigatons of CO2 in 2020, which means that in 2021, the remaining carbon budget amounts to approximately 268.5 gigatons of CO2. So you can see where this is going. As time passes, as we emit carbon, we get a smaller and smaller carbon budget. And so the idea is that the total carbon emissions of companies in the portfolio cannot exceed their share of the planet's shrinking carbon budget. Okay, so that's how we do it. Now the carbon footprint, how do we calculate that? It's emissions of constituent companies multiplied by the weights of individual stocks in the portfolio. And the portfolio is dynamically constructed so that the carbon footprint is constrained to satisfy the overall carbon budget of the portfolio, as I mentioned earlier. And what that translates into is a reduction trajectory for the carbon footprint of the portfolio to be a constant geometric reduction rate of 8% until 2050, following an initial 25% reduction at implementation. We also look at a 10% yearly reduction in footprint as another scenario. And so then the problem we are solving is how to optimize the tracking error of the portfolio by rebalancing the stocks in the portfolio subject to this carbon budget constraint. And the ex-ante tracking error is given to us by the, we estimated, so it's the estimated standard deviation of returns of the decarbonized portfolio from the benchmark. And we look at a bunch of different market benchmarks. What I'm going to show you first is the benchmark of the MSCI Europe. And we calculate the standard deviation of returns using a multi-factor model of aggregate risk. It's a standard one in the industry, the Barra-1 risk model. And our baseline assumption for carbon emissions is that constituent companies will not reduce their emissions. They will keep them constant. And here's the main, if you want, for the baseline scenario, here's some of the main results. So you can see on the left figure, the budget, the carbon budget of the portfolio, so at about 29 gigatons of CO2. And that's the total budget you have to stay within. And as you reduce your yearly CO2 emissions for the yearly carbon footprint of the portfolio, you can see here at the rate at which you reduce it, you're going to, of course, have a portfolio that looks increasingly different from the market benchmark, the market index. But what we find is that despite the fact that you're moving away from the market index, in terms of tracking error, you have a very low tracking error. So in 2021, it's extremely low, 0.08%. And even by 2050, we don't have an extremely large tracking error, only about 1.9%. And this is done by looking at the carbon footprint. This is an important observation in terms of scope 1, 2, and upstream 3 emissions. Now, one interesting aspect of this dynamic net zero aligned portfolio strategy is that you can calculate which companies you're going to remove from the portfolio in order to have a lower carbon footprint. And here I show you the plot for energy companies as they exit the portfolio based on the MSCI Europe, and you can see the name, some of the names here. By 2030, BP would leave the portfolio, 2031, Equinor, then 2035, Royal Dutch Shell. And the point about all this is that, of course, this is a simulation, it's a prediction, but it tells companies, look, we are net zero aligned investors, and we will stop holding your stock at some point in a predictable way if you don't reduce your carbon emissions. And another important point that we make in the paper is that time is of the essence here. If you were to start reducing the carbon footprint of the portfolio later, you would have to reduce it at a faster rate. And what you can see here is that if we start immediately, we would have to reduce at a 10% rate per year, as I mentioned earlier. If we wait a little longer until 2024, we would have to reduce at 18%. And then by 2029, if we haven't done anything, it's no longer possible to be net zero aligned. And in terms of risk management, this is an important picture. So what this picture plots is, you can see the blue dots, that's the 1.5 trajectory to be net zero aligned. And then the orange dots are what the portfolio or particular companies carbon pathway is. And you can see that if you are, as a company, if you're deviating from that pathway, you're exposing your investors to a lot of risk, because at some point there will be action taken to bring those carbon emissions down. And so the risk management problem here is very concrete, very precise. And that's one important reason why investors will have to, institutional investors, very large institutional investors, will have to increasingly shrink their investments in companies that have very high carbon emissions. If I have still a few more minutes, please, Denise, if I run out of time, you should let me know. But if I have a few more minutes, let me now turn to the implications of climate change risks for central banks and the complementary role that central banks will play or can play. And what's important here to realize, this is something that happened in a way under the radar and wasn't really noted much in the US, but central banks have stepped into this field and have recognized that climate change risks can pose systemic risks for the financial system. So the first time this kind of discussion started was in December 2017 at the One Planet Summit in Paris. This then grew rapidly to include about 30 central banks in April 2018 that met in Amsterdam. And in October 2018, the Network for Greening the Financial System, NGFS, which is if you're on the club of central banks thinking about these issues, issued a report saying that climate-related risks are a source of financial risk. It is therefore within the mandates of central banks and supervisors to ensure the financial system is resilient to these risks. And in December 15, 2020, the US Federal Reserve joined the NGFS. It now pretty much includes all major central banks in the world, and they're thinking hard about how to address this major challenge. Of course, the first question they will be facing, more so even than for investors, just for investors, is what's the nature of the risks they're facing? I have participated in a report called the Green Swan Report, where we sort of map out what all the risk considerations might be that might be relevant for central banks. The point we make is that what economists have studied under integrated assessment models is not adequate for central banks. They need to go beyond that. And one reason why they need to go beyond that is that these integrated assessment models are not very reliable when it comes to estimating physical damages from climate change. And also they are very pared down models that typically don't integrate a financial sector, financial constraints, transition risk, social, political, geopolitical risks, etc. And so what we've been arguing, and in a way this is a practice that is now being embraced by central banks, is that you really need to approach the analysis of these risks through scenario-based, forward-looking risk assessments. And there's many different ways you can do this, not just through integrated assessment models, but other methodologies. Let me not go into them in the interest of time. But the point is that this was also something that was mentioned in the panel before lunch that you really need to think in terms of system-wide transition to properly account for the nature of the risks you're facing as a central bank. And the Bank of England is leading the way here with its biennial exploratory scenario that is now currently in place, BES in short, where it is basically pushing banks under its supervision to understand better what the climate transition risks are that they're facing, what's their carbon footprint in their balance sheet, how are they planning to shrink it, what are the costs that they are likely to face. And what's interesting here is that by doing this, conducting this exercise, biennial exploratory scenario, the Bank of England is in effect performing a form of indicative transition planning, because it's laying out a pathway that the UK economy will follow in terms of decarbonization, and asking the banks, and of course through the banks, the British economy, the largest companies in the British economy, how they are aligned with that pathway. That's a form of indicative transition planning, and I think this is important to emphasize, and this is something also that was mentioned in the panel before lunch, the important role of planning. Now, there are many other things that central banks are discussing and that they could do, but let me not go into those, and let me conclude by saying again, so the main point of my talk, which is that climate finance should be really framed as a risk management problem. And financial institutions, institutional investors need to align their balance sheets and portfolios with net zero targets purely from a risk management perspective. Central banks can guide and supervise the decarbonization of the financial sector to reduce systemic climate change risk. And central banks can formulate forward-looking scenarios around which financial institutions can build their climate change risk management policies. So that's really the key role at the moment of central bank. It's the indicative planning role. They're showing the way, and they're helping institutions to structure their risk management around those pathways that provide critical guidance that the central bank is putting in front of them. Okay, I guess that's what I was going to say. Hope I didn't speak for too long.
That was absolutely perfect. Thank you so much. That was a fascinating talk. We have some questions in the Q&A box. If others would like to add to that, please do. Before we turn to them, I have a question related to the first part of your talk, where your description of a net zero portfolio alignment is very attractive and would likely facilitate decarbonization by favoring companies that are reducing greenhouse gas emissions. But I noticed that something similar to what you propose has met with some difficulties. Last week in the Financial Times, I read, and I quote, that a UN-backed green investment fund is on the brink of failure 3 months after its launch during the Glasgow Climate Summit because institutions, including big banks, never delivered expected seed funding. The MSCI Global Climate Select Exchange Traded Fund was unveiled in early November and excludes fossil fuel companies and boosts holdings of companies with lower carbon emissions. The fund has amassed less than $2 million and is likely to be wound down as soon as the end of March without further investments at the fund manager. Bank of America, Citigroup, and Santander pledged to provide seed money, but have refused until other investors do. And so I'm just wondering if you could comment on why corporate commitments in such funds are not actually being realized, or are their commitments greenwashing? How can they be increased? Because clearly such funds would be really helpful. And I mean, I think this general idea is attractive to investors, but how can this be realized more successfully?
Yeah, that's a great example you're giving here, Denise. So it's not the world out there is not one where asset managers aren't trying with new innovations. This one example failed. It's a failed attempt, but there are others that have succeeded. The world of ETFs, unfortunately, is a world where you have a lot of ETFs that get launched. Most of them fail, they never take off. Thousands and thousands of ETFs. They never get big enough to provide liquidity to their investors. But it's a very skewed distribution in terms of the size of ETFs. There are a few, maybe 10 very large ones, and on the other end, you have thousands or hundreds of ETFs that are struggling to gain assets under management and be large enough so that they can function and provide adequate liquidity to their investors. And this example of a fund is, it started small, it was too small, it didn't attract enough attention, and it failed. But the point is that MSCI as a index provider has been putting out a lot of what they call decarbonized or low carbon indices, and they provided ESG indices and so on. That's a lively market. Maybe too much innovation, I would argue here, because it would help to have more concentration. So it's happening, but I guess my point in my talk was that we will really need to look in the next few years at huge transformation in this market, because if the alliances that I mentioned, asset managers, BlackRock's in there, Vanguard is in there, they really mean what they say, they're going to have to ramp up their decarbonization of their assets on a big scale. And so the point is that we're showing a way to do it. Now, that's obviously not the only way, but it's one, if you want, coherent way of framing the notion of a net zero alignment.
Thank you. Yes, let's hope that they become more successful. I noticed a couple of panelists, former panelists, were interested in asking a question. Mar, would you like to go ahead and ask your question, or would you like me to read what you wrote? Well, why don't I start by reading it, and then he could perhaps chime in?
Yeah, I could read it. It's just that the kids are having dinner, so I might be better if you read it.
Okay. There was a claim that ESG has emerged to step up from failed government policies. I would say that the failures of these policies are very much related to lobbying efforts by some of the same corporations that are claiming to take ESG seriously. The question is some skepticism warranted?
Yeah, definitely. And I think it echoes a point that was made in the previous panel. I think greenwashing, that's it's sort of a generic term here, will become a frontline issue, because there's just too much talk that's empty rhetoric, and it's not really followed by concrete actions, and there is not enough accountability on what do these companies mean, what do these institutions mean when they say they are participating in an alliance, net zero, and they have all kinds of plans. And so, yeah, but the point of my talk was that even though a strong dose of skepticism is healthy here, one shouldn't also think too ambitiously about what ESG should do. And certainly one shouldn't think of ESG as replacing government action. I think that's going too far.
Thank you.
Yeah, thank you. It was very helpful. Thank you.
Okay, great. Christian, would you like to ask your own question?
Yes, thank you, Denise. Two things, in fact, to react to this first point you just made. There is a tension between what you just said, that the financial market cannot replace the public power of states to impose aligning private interests with the common good, And what you do in the second part of your presentation, where you impose a intertemporal carbon budget to your portfolio. How can you join these two ideas together?
Yeah.
That was my first point. Second point, I'm working on a similar idea, but rather than putting an intertemporal carbon budget to portfolio, why not imposing a social cost of carbon, a sequence of social cost of carbon, and reevaluating the value of assets from a social point of view by subtracting from profits, or the flow of profits, the flow of the value of the emissions of CO2 using the social cost of carbon. That would be closer to the big picture, where the social cost of carbon provide the unique price signals to the entire community of citizens, investors, consumers, entrepreneurs, and so on.
Yeah, Christian, thanks for these two questions. So on the first one, the carbon budget idea is really, and you know, is there an inconsistency with what you know, we're urging investors to do? And my introduction saying, well, they shouldn't replace government. Here, we are not replacing government. Here, they're acting guided by government to accomplish a net zero goal. Okay, so that's why we really think in terms of net zero alignment. Governments have set the pathway. They said, we want to be net zero by 2050. Here's our pathway. And then we're saying, okay, asset managers, what are you doing to be aligned with net zero, and how can you do it, right? So that's it's complementary to government action. It's not substitute. And to your second question, I think it's very complementary what you're saying. So, and in fact, you know, NGFS is also mapping, you know, pathways into social cost of carbon. They say, if we don't have a pathway to net zero, we will have a higher social cost of carbon. So you can have a social cost of carbon as a shadow price that allows you to evaluate the benefits of this risk management, right? So you can definitely do that. Now the difficulty though is, you know, you have to do an extra step. You have to say, what's the social cost of carbon? How is it going to change over time? You know, how is it going to materially affect the portfolio? That's a more complicated, in a way, a more complicated exercise.
But one certainly quite valuable. I'd like to move on to the second part of your talk. There's a number of questions sent on the central bank role. And Masaki Yashimori asks, the Fed's dual mandate is unemployment rate and inflation. Should they add another mission? Is this a financial regulation matter?
Yeah, actually, that's a great question. And, since the financial crisis, people have realized and come back to the more traditional role of central banks, which is not the dual mandate, it's a triple mandate. The third mandate is to maintain financial stability. Climate change risk is a threat to financial stability, and that's why they have to take it into account. That's really how the NGFS is framing the problem. So we have to accept that central banks have been created first and foremost to maintain and to help maintain financial stability. That's their primary role. That's, you know, the Federal Reserve Act of 1913. That's what it was about. There was no, Taylor rule in 1913. There was no trade-off between inflation and unemployment. It was all about financial stability. And we've come back to that with the financial crisis, and that's why we've had stress tests since the financial crisis and so on. And that's how naturally you can augment the risk management part, the supervision role of the monetary authorities with a climate dimension. And by the way, that's now accepted by the Fed. Fed has joined the NGFS, has agreed to that, and The Biden administration has put out an executive order, basically pushing in that direction. So this is now basically policy.
A related question here is coming from an anonymous attendee who asks, central banks are supposedly apolitical in that respect, may be able to fulfill the role of the impartial planner. Is there a risk that central banks may not be as apolitical as we assume? And I'd add on to that question the point that I think we discussed yesterday about how Biden has nominated someone who is very attentive to climate risks, and she's being really blocked by the Republican contingent who really doesn't want to see climate taken up by the Federal Reserve.
Absolutely, yeah, that's Sarah Bloom Raskin, which is a great nomination, I have to say. Yeah, well, central banks are supposed to be apolitical, but they are not, they're still exposed to politics. And we see that every time the Fed chair is speaking to Congress. And, there's even whether you should increase interest rates to tame inflation is a political issue. And members of Congress differ on these things. But central banks have been made independent. That's another thing that is a later evolution, the independence of central banks, because the view was that politics interferes with good monetary policy. That's why they're independent. And as independent agencies charged with financial stability, they have a role to play in taking into account climate change risk, and that's within their mandate. By the way, a very interesting talk by Jay Powell in June at a conference, a BIS conference, the Green Swan conference, where he laid out the mandate of the Fed, and he said financial stability and therefore climate change risk is part of the mandate and has always been. It's just that climate change risk is a new risk that we now have to are confronted with. It's not we're changing the mandate; it's we're faced with a new risk that we have to deal with.
Very, very interesting. I think we have time for another question, or maybe two if we're quick. Another anonymous attendee asks about what the role is for other financial institutions, such as reinsurance companies, insurance companies, as well as quasi-governmental bodies such as the SEC, CFTC, or the FSA in the UK. If you have an opinion on that.
Right, absolutely. Well, that's a big question, right? All these institutions, each one plays a somewhat different role. But the point is, the framing of climate change risks or climate finance as a risk management problem applies to all of these institutions. Some of them are regulators, others are financial institutions like insurance companies and so on. Insurance companies, they also have to worry about having their assets be net zero aligned. That's an important hedging exercise they have to take into account. Now, as far as the SEC is concerned, SEC is all about disclosure. It has to step in here to help investors get the information they need, material information for their investments. And part of that information is disclosing the carbon footprint, carbon emissions of the companies that they're investing in, because that's now a material risk that investors are facing. So we're seeing a big pressure to disclose climate-related financial risks everywhere in the world, but especially in the US, and the SEC will come out, I think, this year with a report on some concrete proposals on how to enlarge disclosure.
That will be a positive change. I think On that note, we've run out of time. Thank you so much, Patrick, for your excellent insights. We really appreciate your joining us. I was very pleased to be part of this. Thank you to the organizers. And we will see you for the final panel shortly.
Thank you, Denise, and thank you for managing the presentation so smoothly. Thank you very much.